So Ben, visibility on inflation remains unclear, but there is talk now of tapering. There's talk of rates perhaps increasing faster than expected. It's not a great environment if that happens for tech stocks. How does that affect your positioning?
No, I think you're absolutely right. I mean, I think the rate environment, inflation, and more importantly, inflation expectations feed very, very keenly into style in stock markets. And obviously, as inflation has been trending higher, obviously headline rates at multi-decade levels, certainly there's been a rotation away from growth in favour of value and sectors that are perceived to do better in an inflationary environment. Look, I think it's fair to say that we're also unsure about what the future holds for inflation. We're not economists, and I'm not sure that they even have the answer at this stage. What we know is that during this reopening phase or stage of the recovery, there's clearly imbalances, demand and supply, and lots of money has been created. Household balance sheets are in the best shape they've been in a long time. And so, yes, we are seeing that manifest in things like higher inflation. Look, from our perspective, we're heartened by the fact that the Fed sees it as transitory. The bond market appears to believe that too. I think that we're also seeing, and this is maybe less relevant in the UK and the US where vaccination levels are high, but in other parts of the world, the recovery trajectory is looking more like a two-step forward, one-step back path. And so much of China has been locked down recently. New Zealand is not having a terrific time of it right now. So I think, I think that where the market's at reflects this somewhat binary setup with inflation. Last point to make would be, from our vantage point as tech investors, where we hopefully can bring some value to this debate, is that we see many sort of multi-year drivers in place that should be able to offset anything more than transitory inflation. We see, the idea of using more software as a way of automating business processes. We should be able to drive productivity higher through a number of different things centered around hybrid work. So I think the jury's out. But from our perspective, let's not forget that risk-free rates, which are obviously very important to how certainly the longer duration tech assets are, even if they rise from it, even if tapering happens, they're happening from a very low base.
Ben, you and the team manage global technology portfolios. You have a large overweight to the US, but we can't ignore what's going on in China, state intervention affecting a lot of large Chinese tech companies. What's been your reaction to that?
Well, I mean, on a prosaic level, we're obviously disappointed. We're long-term holders in both Alibaba and Tencent, and while we've reduced both positions very materially, we still hold them. We still think they're great businesses, and we kind of feel that they're not trading on fundamentals right now. But it's difficult for them to do so when the Chinese government is, moving the goalposts, for want of a better phrase. What's interesting from our perspective is it's a good reminder that you want to remain diversified. Getting super excited about individual stocks that look too good to be true is often quite an expensive investment decision. And so within our portfolios we maintain diversified portfolios across multiple themes, and that somewhat mitigates events like this. Donald Rumsfeld, unknown unknowns, and it doesn't feel, from our perspective, that the change in tone from the Chinese government is changing, and if anything, it seems like it's actually gathering negative momentum with something that was designed to sort of curtail platforms moving more into sort of social goals, which I think are quite incompatible actually with our interests as shareholders. More broadly, it's just a good reminder that regulatory risk exists. A year ago, we were all worried about the US platforms, and what's different about the US relative to China is now fairly obvious, which is due legal process, a well understood process that recently saw the FTC, in its case against Facebook, actually suffer a setback. And so I think, if anything, you've seen money flowing out of China into other parts of the world where there is maybe lower political risk, and where the regulatory risk associated with some of these internet platforms is more easily measurable.
Another interesting area, valuations. There seems to be a healthy scepticism on whether technology stocks can continue to rise from here, yet we saw a lot of estimates on earnings being beaten quite significantly. What do you think is the next kind of catalyst for the next leg of the tech rise?
Well, I think quickly on valuations. I mean, valuations of everything have gone up, and I think a lot to do with monetary policy, the creation of lots of money, unprecedented peacetime stimulus, and so what's true within tech is true elsewhere, and not just within equities, across lots of different asset classes. I suppose from our perspective, the overall valuation picture doesn't look that different to how it's looked since the financial crisis really ended. From a relative perspective, the technology sector has traded roughly in a band between 0.9 and 1.3 times the market multiple since the financial crisis low. And right now, we're towards the top of that band. But why shouldn't we be? I mean, the sector has just performed phenomenally well last year. Many of the key trends have mapped perfectly to the kind of challenge posed by COVID. Actually, this year, the tech sector has held its own in earnings terms, despite the fact of having really tough comparisons, unlike most other industries, which suffered very greatly in the first half of last year, and also much less leverage. I mean, we just have much higher margins than the market, and so in a kind of recovery phase, I think the market expected tech to trail very materially, and that hasn't happened. And I think the reason for that ultimately is because the themes that matter within tech are multi-year in nature, and COVID and this idea of a new work modality are huge tailwinds for tech fundamentals.
New work modality, something you've talked about a lot, hybrid working. Can you talk us through some of the investment opportunities perhaps outside of the obvious, so everyone knows about Zoom, etc. What else are you seeing?
Well, I mean, it's a great question, and I think as consumers we've enjoyed and maybe become fed up with some of the vestiges of the hybrid work model. So we think about the opportunity sets really as sort of threefold. The first one would be the idea of what happens to cities and offices, and we've now learned during the pandemic that companies probably need less office space. But what fills the void? And our view is things like deurbanisation and the idea of being able to access labour markets beyond the normal reach of a company is hugely exciting. But from our perspective, we're kind of focusing on things like electric vehicles and renewable energy as cities fight back a kind of greener, fairer, cleaner type of model. We're also excited about what the new work modality means for our homes, our neighbourhoods, because spending more time there means we'll invest more time and money in them. And I think that we may have saved the high street. We're going to consume services locally if we are at home more. Our activities, our pastimes will change. Our delivery windows will be greater, which will be great for e-commerce companies, but also for the likes of HelloFresh. If I know I'm at home on a Tuesday and a Friday, I'll have a meal kit delivered and I can actually make food for the family and enjoy it. I suppose the most important takeaway is this idea of transforming work. And it's the least obvious of the ramifications of hybrid work. And by this we mean the idea of abstracting work from the workplace, which then creates a sort of fundamental shift in how work is orchestrated. We start to unitize it, we can measure it, and then we can digitize it and then create data sets that ultimately we will run through AI engines and transform the nature of work. So hugely excited about the last of those three forces, if you like, based on hybrid work.
Okay, and finally, outlook for the sector. Sound like you're positive or cautious?
Oh no, we're hugely excited about the prospects for the technology sector, and yes, there are parts of the market where valuations feel a bit elevated, but maybe that's understandable against the backdrop of COVID and our sector delivering incredible growth, frankly, in a very challenging environment. So more generally, the reason we're so excited, is because the technology sector continues to deliver on its earlier promise. Things like smartphones and cloud computing, demographics are just multi-year trends that the pandemic may have accelerated some of the adoption, but ultimately are tailwinds that should last for a long time. Things like cloud, still in the mid-20s of penetration. So hopefully that should support growth for years to come. And then we've got data sets growing like a weed, and AI just beginning to move into the mainstream. So I don't think we could be very much more excited about the prospect for technology fundamentals. Some of our enthusiasm gated by elevated valuations in pockets of the market.